All right, I'm Michael Hartzman, and today is Tuesday, April 7th, 2026. And tonight we're switching up the Leventhal report a little bit. We have Andrew Gilmartin, our director at Leventhal Wealth Advisors and certified financial planner, sitting in for Dominic, who's out of the country. And we have Jack Manley, who's global market strategist and executive director at JP Morgan. And Jack, there's so many things going on that rather than Andy and I having a conversation in the beginning like I normally do with Dominic, we're just gonna jump in right with you. So welcome back, I should say,
Yeah.
to the podcast, Jack.
Yeah. Well, thank you for having me back. It's always great to be here and chat with you guys.
Thank you. So look, I know you basically spend your days, your career trying to explain to people what the hell's going on. Um, which is especially challenging more times than others. And I think we're in that kind of space right now. And for me, Jack, um, really the question which makes me the most nervous is kind of counterintuitive is, why isn't the market down more when, we have a president literally saying, he's going to blow a country, out of existence and
Uh-huh.
people are going to die tonight. I mean, what's the logic behind the market's resiliency?
So it's interesting to point out, first of all, Michael, to your point, that despite the fact that this has been a market that really since the start of the year it has been headline driven, because right, of course, right now we're talking about Iran and oil. But this year started with regime change in Venezuela. I think this is a fun exercise, by the way. Maybe fun's the wrong word, but it's an interesting exercise. Regime change in Venezuela, threats of something similar, or at least talks of something similar in Greenland, a meltdown in the Japanese government bond market, a explosion in precious metals prices, a rout in private credit, a Citrini research report and concerns around AI, blow up in software stocks as a result of all that, and now conflict in the Middle East, right? The greatest oil shock that the world has ever seen in history. And yet, despite all of those things, right, not just these headlines over the past month, but despite all of these things, the S&P 500, I was just looking at my stock app on my phone right now, is year to date in price terms down only around 3.5%, which means when you incorporate in a dividend return of, let's call it like 1.52 percentage points, that's roughly where it is, you're looking at a market that essentially is flat. And that is extraordinary. Now, I think it is also, though, a continuation of something that we've seen, sort of a defining characteristic, I guess I'd say, of U.S. markets and the U.S. economy more broadly. We've seen this over the last several years. I mean, think about how many times people were calling for a recession that never materialized. I mean, 2025 is a great example, right? Like one of the most widely held views out there was that this economy was going to tumble into recession, and you got a first quarter GDP print that was negative, the first negative one that we've seen in 3 years, and all these people concerned that that's your confirmation of this recession that's halfway there, and then nope. We roar back to life in the second quarter. The momentum continues in the third quarter. If there hadn't been that pesky government shutdown in the fourth quarter, we probably would have seen the momentum continue through there. We saw it happen in 2022 when the Fed started raising interest rates. You look at what happens with the equity market. Don't forget that in April, around this time last year, the stock market's down almost 19%, and yet it closed up over 15% by the time 2025 wrapped up. This idea of resilience is something that you see kind of across the board in the U.S. economy, in U.S. equities. And it's something that, as I said, has kind of become a defining characteristic of our markets and our economy in particular. Maybe not uniquely, but certainly in particular. And so I think that's like always kind of helpful context to have, right? But when you look at what's happening actually within the market, that's where I think things start to get a little bit more interesting, because at face value, sort of at surface level, you have a market that's off what, like 1.5, 2% in total return terms. But if you open up the hood and look at different sectors within the market, you start to see a much bigger kind of dispersion in performance. Like I'm looking right now on the side of my screen at our latest guide to the markets presentation. Financials are up 20%. this year. Excuse me, no, financials are down 8% this year. Energy stocks are up 35% this year. Technology is down 7%. Staples are up 9%. Like, you have a market that at surface level looks very calm, looks very flat despite all these headlines, and yet a lot of churn underneath the surface. You take that one step further, there are over 300 names within the S&P 500 this year alone that have experienced a 5% pullback or greater at some point in the past 3 months. So a deceptively choppy market, I would say, despite that kind of headline tranquility. Something else that I think is interesting to point out. So, a lot that can be said about all this, but I think those are a couple of good kind of foundational things to kick off this conversation.
Andrew?
So when we think about Iran specifically, right, and that's kind of the headline that's causing the most recent volatility, rather than asking when do we see this ending,
Thank you.
How long can this go on for until the market really starts to say, okay, we have an issue, and this is going to kind of come down to the foundation and start breaking things?
Yeah, it's a good one, Andy. Thank you. I do mean thank you for not asking when it's going to end, because that is, understandably, like, everybody's number one question. But like, I am not a military strategist. I have no idea when this thing's going to end or what even ending actually looks like. I don't know what victory means when it comes to what's happening in the Middle East. But how we think about it translating into macro, into markets, that's where I think we can actually add a little bit of value. And when I've been having conversations with clients, I've found it very helpful to kind of establish right up front a sort of baseline axiom. And it is not a controversial one by any stretch of the imagination, but it is at least helpful to kind of ground these conversations. And that axiom is that energy shocks like the ones that we are experiencing right now are, without argument, stagflationary. You can argue, of course, that higher energy prices are good for energy companies. That's probably true. Energy makes up a relatively small component of economic output in the United States, less than 5% of GDP. Whatever happens to the energy sector, whatever gains they may witness, will not be overshadowed, or will be overshadowed rather, by any losses that we see in consumer purchasing power because gasoline prices are higher, or industrial spend because it now costs more money to run the generator or keep the lights on. A shock in energy prices is bad for growth. It's also bad for inflation because energy is itself a component of CPI, and higher energy prices will feed directly into higher headline CPI. But also, sort of related to that growth story, almost everything that we consume consumes energy. If diesel costs more money, so the combine costs more money to run, then the food that you eat will eventually cost more money. If jet fuel costs more money, then your airfare is going to cost more money. Your vacation will end up costing more money. The blast furnace costs more money to fire, so the automobiles that you're buying are going to cost more money. And by the way, if they're made overseas, the tanker that's shipping them over here now costs more money to fuel up. So again, you're going to have higher prices, right? So higher energy costs are inflationary, both indirectly and directly through headline CPI, indirectly through all the knock-on effects. That is the very baseline, again, not controversial, but important point to establish right up front. Energy shocks are stagflationary. So the question is less about what's going to happen, and more how bad will this get, right? How stagnant will the economy become? How inflationary will inflation actually be? And to have a view on that, I think it is important to understand sort of what the baseline expectations would have been for this economy. In other words, where were we coming into this thing? And once you have an idea of where we are, it becomes easier. I don't want to say easy, but it becomes easier to have at least a view on where we might be going. So a few things to say on that, I think, Andy, right, kind of up front. The first one, which has been discussed pretty frequently, but is, I think, nonetheless important to point out, is the United States is energy independent and a net energy exporter. That does not mean that we aren't going to feel the impact of a supply shock in energy that's happening 5,000 miles away. Crude oil is traded globally. It's priced globally. The cost of a barrel of crude in the U.S. is $3 higher than it was yesterday. It probably has more room to run to catch up with the benchmarks that you're seeing in the Middle East. We know that that these prices are going to rise. What we won't experience, though, is a 1970s style supply shock domestically, where people are queuing up to be rationed for gasoline at the stations based off of the digits on your license plate. We make enough of this stuff. We are not going to have a physical experience supply shortage domestically. We'll have to pay more for it, but we will be able to access it. That's important. Another thing to point out, and again, mentioned frequently, worth repeating, this is a country that, like many countries, has become a lot less crude oil dependent. Some of that has to do with just broad gains in efficiencies. The way that we use crude oil and its distillates is a lot more efficient than 20 years ago, 50 years ago. Think about, the mileage that you get on a car that you buy today versus the mileage that you would have gotten on a car that you bought in the 1970s. Like it's night and day. We're a lot more productive with the energy that we consume. But then you also have in the United States something that, again, is not unique, but is special, which is that in this country over the past decade and a half, we have gone through a revolution in natural gas production. And it is abundant. It is extraordinarily cheap. It is priced locally as opposed to being priced globally. So while nat gas in Europe is trading at very high levels, nat gas in the U.S. has barely budged at all. An enormous amount of our industrial processes that used to run on crude oil have shifted over to natural gas. Not all of them, but a good amount. All of this is to say that the U.S. economy today is structurally much more insulated from any energy shock, whatever it looks like, whenever it happens, than it was even 20 years ago in the years leading up to the financial crisis, let alone 50 years ago, the last time we saw an oil shock this meaningful. When you think about where we are right now in particular, I think that's where things get even more encouraging. Yes, we will see a hit to growth, undoubtedly, because of higher oil prices. But this is an economy that, like Michael and I were talking about earlier, is remarkably resilient. It's defied a lot of expectations. It has a consumer that's willing to spend through good times and through bad. I think retail therapy is a real thing in this country. It's an economy that was set to and is currently receiving an enormous amount of fiscal stimulus, thanks to the changes to the tax code from last year's One Big Beautiful Bill Act, right? Being able to not pay tax on your tips, on your overtime, being able to write off certain interest expense, the increase in the SALT cap deduction, enormously impactful for all earners in high tax states. I'm based in New York. I'm getting a tax refund for the first time in a decade because of the changes to that tax policy. And we're going to get that money and we're going to turn around and spend it. And yeah, maybe 2 months ago, we wish we were going to spend it on, a new TV or a cool vacation or a couple fun dinners out. Now maybe more of it has to go to higher gasoline prices, but there's a buffer in place, already in place. No new legislation has to be passed to help to absorb some of these higher costs. And underneath the surface, you have an economy that for several years now has been buoyed by what's effectively a secular theme, and I'm sure we're going to get into this later, which is AI. AI-related CapEx business investment was the single largest driver of economic growth over the course of the first half of last year. And we spend a lot of time talking about how AI and the spend there has had such a loud and very obvious impact on the equity market. It has had just as important an impact on the economy, albeit in a much more quiet, much more subtle way. Hundreds of billions of dollars getting pumped into this stuff. It's only picking up this year, and the hyperscalers do not care what a barrel of crude oil costs. This stuff sees through commodity shocks. It sees through even economic cycles. That's why we consider it to be secular. All of this is to say, Andy, right, like a little bit long-winded, but I think it's important to hash all this stuff out. This was an economy that was resilient going into this year, an economy that was set to be bolstered by fiscal stimulus, supported by AI-related CapEx. In other words, an economy that was likely going to grow at least modestly above trend. And we can now take that forecast and shave a few tenths of a point off of it. Right? We're not talking about changing the polarity. We're not talking about expansion becoming recession. We are talking about an economy that was probably going to grow at 2.5%, and now maybe it's going to grow at 2%. Maybe it's going to grow at 1.8%. It's not great news, but it is certainly not ruinous. And I think that view, by the way, helps to explain, what Michael was pointing out earlier, at least partially, like why this equity market hasn't budged a whole lot. Because the macro view, at least on growth, hasn't really budged a whole lot either.
And I think
Yeah.
what I heard you say there was two things, right, that stood out to me. The country's less reliant on global oil, more self-reliant. So the market resiliency is partially, in fact, because of that. The worst case scenario is not going to be as bad as it would have been decades ago.
Sure.
And with AI making things more efficient, maybe inflation is lower than it would be because of the effect of increased oil prices.
AI helps with the disinflationary narrative, certainly. But even just like plain old boring math helps with the disinflationary narrative, right? Like at some point, and again, glad you're not asking me when, but at some point, this thing's going to wrap up. And when it wraps up, crude oil prices will fall. And while they may not fall to where they were before this stuff kicked off, they're going to fall to lower than where they are right now, which means that this inflationary impulse that we're dealing with right now is going to turn into a disinflationary impulse. It's going to turn into a deflationary impulse. And by the way, kind of in the spirit of talking about like, what the baseline expectation was, the most recent CPI report this year for February was 2.4%. So you get an extra 100 basis points, even an extra 150 basis points of energy-related CPI. It still only takes you up to a number with 3 handle on it. Like we're not talking about the 7, 8, 9%, dog days of 2022. This is a very, very different, I would say, environment.
So Jack, getting back to what you were talking about, inflation and stagflation.
Yeah.
Your boss, Jamie Dimon, who we've been fortunate enough to be in the room with several times. He's one of the few CEOs, in my opinion. His comments, his thoughts matter. When he says something, it always gets media attention, I think. And he made a comment yesterday in his shareholder letter, which I'm sure you read. But the takeaway was when he described rising inflation as the skunk at the party, which is fantastic.
I like that, yeah.
Right? But it's kind of in line a little bit with what you just said, isn't it? That we just all have to be mindful, no matter where we get it from. Inflationary scenarios could throw this resiliency into somewhat into a turmoil environment.
It's something that markets are definitely grappling with. And I wish I could figure out how to extend this metaphor further, because I do like that metaphor a lot. But the other problem with inflation is that in many cases, the cost of reducing it is too high to handle. Like I've been very lucky to be able to hear a few central bankers speak in a number of different forums. And one of the things that I've heard pretty consistently is that, for the end user experience, like the average American, the only thing worse than rising prices is losing your job. In other words, like, we're going to complain and complain and complain about the cost of a big gallon of gasoline being up 30 or 40 cents. And we'll complain about how expensive, vacations have become, or how much money it costs to go out to eat. Or like I went to go try to buy Yankees tickets like a couple of days ago, and it was like $500 to go see them play up in the nosebleeds. Like, we'll complain and complain and complain, but I am certainly not willing to lose my job to push those prices lower. I'd rather complain and deal with higher prices and still be employed. And so I think ultimately the risk to the narrative, if inflation picks up, is that the Fed's going to have to change course. And if the Fed changes course, then you're all of a sudden discounting all sorts of things differently, and your outlook on fixed income has to be adjusted. But I actually don't think the Fed's going to have to meaningfully change course. In other words, I don't think we're going to see a narrative change from cuts to hikes because I don't think the Fed wants to put increased downward pressure on a consumer that's already in a decent amount of pain.
Well, I also think, and then we'll take a break after I make this comment. If the new Fed chair does not lower interest rates, I think Trump will ask him to be put in jail.
Yeah, I don't envy Kevin Warsh. That is a tricky position to be in right now.
Yeah,
so, yeah. But it surprised me.
So listen, it's a great spot to take a break. And Andy, when we come back off the break, we'll give you the first word. But Let's get Jack Manley the opportunity to catch his breath, and we'll be right back after a short intermission. All right, I'm Michael Hartzman. I'm back with Andrew Gilmartin, director at Lebenthal Wealth Advisors, one of our own. He's a CFP and he runs our financial planning division. And Jack Manley, executive director and global market strategist at JP Morgan. So, Jack, we had an interesting first half of the conversation. I think Andrew wants to switch gears, and you are the global market strategist. So, I think Andrew's ready to step out of the U.S.
Yeah, thank you, Michael. So one of the things that I've heard you talk about is it's been a great year for diversification, right? Not only within the U.S. market, but internationally. And we've seen countries like Taiwan, Brazil, Korea, kind of on track for another really good year, following up last year's performance. Why hasn't this all affected them as much as the U.S.?
Hmm. Well, sort of. I mean, honestly, I guess I'd sort of scratch my head on that one too, because when I think about the foreign market outlook, and I think, of course, when you're talking about foreign markets, it is helpful to draw a distinction between developed markets outside of the U.S. and then emerging markets, of which you named a few. When I think about the foreign market outlook, the EM one is always very interesting, but it's also always kind of the wild card, right? Like EM has long been the promised land. It's long been the way where that you can generate these outsized returns. But because there's so much volatility in the space, that your experience as an EM investor is going to depend a whole lot on when you get in and when you get off. Like depending on what your time horizon looks like, depending on what your investment horizon looks like, you know, a very good experience or a very bad one. Underneath the surface for emerging markets, you have some longer term kind of, again, secular themes that are maybe helping to provide a little bit of buffer here. You're thinking about the transition away from China as the world's sole source of cheap goods, cheap labor, and how other emerging countries, particularly in Asia, are sort of picking up that mantle of responsibility. India, for example, has done a lot of really interesting stuff from an industrial policy perspective, regulatory perspective, from a taxation perspective, and by the way, they have superior demographics that'll actually allow for growth. You have certain emerging markets like Korea, which I know you mentioned, Taiwan, of course, that are very tightly connected to the global AI infrastructure build out. And if you do think of AI as being something of a long-term secular trend, then these countries and the dominance that they have in some of the components that go into building out our artificial intelligence capabilities, I think helps to explain some longer term potential for resilience. You also have within emerging markets this idea that, look, as these countries get wealthier because of reshoring of manufacturing activity or the global AI space race, 21st century space race that we're in right now, you will see the growth of a middle class. And as a middle class like develops and matures in some of these regions, there are, I guess, like sectors, components of the economy, and kind of by extension, components of the equity market that will mature right alongside them. And I always think India in particular is a good example of this. You know, like when you get flushing toilets and running water, which is like table stakes for us, not necessarily table stakes for a lot of places around the world, your life expectancy increases. And when your life expectancy increases and you're not dying when you're 40, but you're dying, way later into life, all of a sudden your healthcare needs become a whole lot more complex. Now you need pharmaceuticals and hospital systems and assisted living in a way that you may not in a country where life expectancy is below 50. Similarly, as you get wealthier, financial services as a sector, as a component mature. When you make $2 a day, you probably aren't saving anything. So you don't need brokerage services. You don't need credit services. If you don't own anything, you don't need insurance services. But as you start to make more money, your financial needs become more complex. So there's a lot of exciting stuff to say about EM, and a lot of these things are kind of secular. They're agnostic to any one particular headline, which is why over the long run we like that EM story. But again, depending on where you get in, is going to depend, and depending on where you get in and when you get out, will ultimately inform what your realized experience looks like. Developed markets are going to be very different, right? When you look at a developed market like Europe or Canada or Japan or the UK, these markets are highly cyclical in nature. There are things like financials, industrials, materials, energy, depending on where you are. And highly cyclical markets, which by the way are very different from the US, but they're going to be much more secular, much more growth oriented, much more tech oriented. Highly cyclical markets like the ones that you'll find in the developed world outside of the States are liable in any given year to outperform their US counterparts. And I think last year was a good example of that. You had some really interesting shifts in like the global interest rate environment, in European defense spending and corporate governance reforms in Japan, all these things making these regions, a little bit more competitive with their U.S. counterparts. But I have always had a very difficult time imagining a world where Europe can consistently outperform the U.S. over the next 10 to 15 years. In other words, like EM can be the high octane stuff, but it's kind of patchy. DM can be the thing that works every once in a while. Maybe it's the thing that's zigging when the U.S. is zagging, but over the long run, we'll never be able to outperform the U.S. because a cyclical market will never be able to outperform a secular market. A value-oriented market will never be able to outperform a growth-oriented market. Coming into this year, as a result of all that, it was entirely possible that you would see another year where foreign markets outperform. I've always been a bit of a skeptic. I think that's probably pretty clear through my commentary. But like that was sort of the party line that the foreign markets are going to outperform. And okay, I can buy that. But I would actually argue that what's happening right now from an energy perspective is a lot more damaging to foreign markets than it is to the U.S. And you look at Europe, and the bulk of Europe is not energy independent. There are only a few energy powerhouses in Europe, which means that they are heavily reliant on imports. Now, thankfully, they've never been particularly reliant on crude oil through the Strait of Hormuz. Up until 2022, they were heavily reliant on Russian crude. We know how that turned out. Now they're much more reliant on American crude or Norwegian crude or crude that's produced in the North Sea or even crude from North Africa that doesn't have to make its way through the Strait, but they are not energy independent. Which means they might feel supply shocks in a way that we won't. And then Asia is not only not energy independent, but they are heavily dependent on crude oil that makes its way through the Strait of Hormuz. So those countries that you mentioned, like Korea, Taiwan, you throw Vietnam, the Philippines, Indonesia, India, Japan into that mix. A lot of these countries are heavily dependent on the crude that is just not flowing right now. So I would actually argue that while higher energy prices aren't good news for anybody, unless you're like Iran or Russia, it's like the U.S. is kind of once again the best house on a bad block. Like it's not great for anybody, but I feel like our macro position or our macro economy is much better positioned for whatever the shock may be than Europe, which is in turn better positioned than Asia.
And to that point, right, those were the cherry picked names. Most of the other EM, developed market countries are not performing well this year.
Yeah, and I think the names that you bring up are good ones because they're the ones that are going to be linked a lot more closely to AI build out and the supply chain related there, which helps to prove like how resilient so much of this stuff actually is.
Jack, staying on the international theme, I've been very curious about China in particular, since there was the attack or the takeover, I should say, in Venezuela.
Yeah.
If I remember correctly, China was Venezuela's biggest customer. And I believe they were also one of Iran's biggest customers. It appears to me, and by no means am I a geopolitical expert, but it appears to me that China has been almost too quiet through all of this.
Yeah.
Because between Venezuela and Iran, I can't imagine for a minute that their economy is not going to be affected by all this disruption in the oil market.
It's a great opportunity to have a wonky conversation because the China story is very interesting. And I think it ultimately boils down to just the sheer size of that country, both like geographically, it is a physically large country, but also in terms of population, and also in terms of the magnitude of the economy, right? China's economy is the second largest on earth. A lot of people would not realize this, but China is actually a top 5 crude producer globally. China actually makes more crude oil than Iran does, which I think is pretty remarkable. They make more crude oil than Venezuela does, which I think is pretty remarkable. China trails right behind Russia and Canada in terms of crude production. The problem is that China is a much bigger, more complicated economy than Canada is, for example. And so while it does produce a decent amount of crude, it also has to import a decent amount of crude. And to your point, Michael, a lot of what it was importing was from Iran. A lot is getting imported from Venezuela. I'm sure they're also buying either directly or through back channels Russian crude. Basically, all the stuff that we won't let you touch. The Chinese are very happy to be customers here. The other thing to point out, though, in addition to the fact that China does have its own domestic crude capacity or crude production capacity, is that the bulk of China's industrial processes still run on coal, which is one of the reasons why they are such an enormous polluter, especially at a per capita level. The bulk of China's industrial processes continue to run on coal. And so while the majority of the crude oil that they consume is imported, and a good chunk of that crude oil is coming from countries that aren't necessarily exporting crude oil anymore, the overwhelming majority of total Chinese energy consumption actually comes from domestic coal, which makes them a little bit more insulated from what we're talking about. That said, I did read, I think it was just this morning, that China has finally entered a little bit more directly into the indirect talks that are happening between the United States and Iran. I believe they're being facilitated in Pakistan, and China has now come to the table. I believe they'll also, through their seat on the Security Council, be speaking directly about this with the United Nations in the not so distant future. China does very clearly want this thing to wind down. They've established, I believe it's a 5-point peace plan, ways to figure all this stuff out. It was only a matter of time before China stepped in and tried to throw its weight around. So I don't think China is at risk of like economic ruin because they can't get a hold of Iranian crude anymore. I think that's probably an oversimplification. But like everybody, they're not happy, and they're probably less happy than the Americans are about the strait being closed down. And so they will absolutely exert their influence, as they already are, to hopefully reopen this thing sooner rather than later.
When we going back to the Fed, do we think that markets are underestimating how long we could stay, at least in a mildly restrictive regime, a little bit above targets for the Fed funds rate, a little bit ahead or above the inflation rate? Is that being priced in properly, or?
It's a funny question because like on the one hand, current macro conditions, and I think you could say that certainly now, and you could have even said it throughout periods of last year, current macro conditions are supportive of rates staying right where they are. In an economy that is able to grow modestly above trend with an unemployment rate that's below 4.5% and inflation that's bouncing somewhere between 2 and 3%. All that suggests that wherever we are right now from a rate perspective is a-okay, right? There are plenty of problems, but generally speaking, at a high level, it is a-okay. So there's one way to argue that, right? That the market, is looking for rate cuts that probably shouldn't materialize. On the other hand, the Fed, at basically every opportunity it is given, reaffirms its belief that we are in restrictive territory and that we are interested in or that we are biased towards continued easing, at least on the short end. Like, I guess it was a few weeks ago, 2 weeks ago now, maybe the Fed had their March meeting, which was interesting, and it was always going to be interesting because it gave them the opportunity to publish their first quarter summary of economic projections. And right, the SEP, to abbreviate it, is always like closely watched because it's how the Fed kind of tells you what it's thinking about the economy. This one was particularly interesting because it was a month after, or about a month after, this conflict kicked off. And the Fed had ample opportunity to say, like, we don't know what's going on. Oil prices are way higher. This might not be good for growth. It might not be good for inflation. But you know what they did? They put out their first quarter summary of economic projections. They barely touched their growth forecast. They didn't touch their unemployment rate forecast at all. They revised their inflation forecast higher by only 0.3 of a point for the course of the year, which in the grand scheme of things is basically nothing. And they reaffirmed what they told us back in December, which is 125 basis point cut this year and 125 basis point cut next year. I mean, like, I don't know how much more clear they can be that the bias here is very clearly towards easing. Now, like, I don't buy the 25 bips this year, 25 bips next year. How is the Fed supposed to know what it's going to do with monetary policy in 24 months, let alone 6 months, when it doesn't know what's happening with this economy right now? But in every single speech, press conference, testimony, symposium, and every single dot plot that we've gotten over the past year and a half, this bias towards easing is continuously confirmed. And to Michael's earlier point before we went on break, you got a new Fed chair that's coming into power almost certainly. And the whole reason he has a job is because he's planning on cutting interest rates. It's the only reason he got the thing is because he's been clear that he's willing to cut interest rates. So you're in this, that's why I said it was kind of a funny question. You're in this weird position where, like, maybe the economy doesn't need lower interest rates. But at the same time, that doesn't mean the Fed isn't keen on lowering them, nonetheless. I don't think they're lowering to the ground. I think that the sort of neutral rate for interest has gradually crept higher, and which means that maybe it only takes one more cut before we get into neutral. But I don't know how much. Like, you can't fight the Fed. It's been something that we always say all the time. And when they tell us at every single meeting and press conference and statement, we're still going to be cutting rates. I don't know, like maybe it's worth believing them.
Take them for their word.
Yeah, why not?
Excuse me. So, Jack, to that point, as it relates to inflation, when there is an oil shock, gas goes up almost overnight, but it comes down slowly. So let's assume for a moment this thing unwinds in the next week or two. How long will it take for gasoline prices to kind of go back to equilibrium where, consumers are comfortable again?
I wish I had a better answer to that, Michael. I actually don't know. Crude oil prices will move very quickly. But to your point, that doesn't always translate directly into the refined stuff, especially because a lot of this stuff is priced out in contracts, and those contracts last a long time. Maybe it'll be a couple months. I'm not sure. Certainly the administration is going to want to see it before midterms, right? When you're thinking about the affordability crisis being such a bipartisan issue. But I guess it is a good reminder that even when you get the all clear, whatever that looks like, it doesn't mean that the next day everything goes back to normal.
Well, and then that was my point. I mean, I think if we're midsummer and gas is still $4 a gallon, I think the Republicans in general and this administration in particular, they're going to be sweating a little bit because consumers have a long memory. And I said this morning on our weekly broker call, you're spending $70 a week to fill up your SUV. That is going to be reflected in a voting booth more likely than not.
Absolutely. And the timing of all this stuff is not particularly good because gasoline prices always rise as you move into the summertime because that's when we're all on vacation and taking our trips. So like conflict or not, Strait of Hormuz open or closed, oil prices, gas prices, we're always going to move up over the next few months. So you might be in this interesting position where the conflict ends tomorrow. Equilibrium is achieved the next week, and gas prices are still higher than they were at the start of the year, just because of those seasonal dynamics. But the perception will be that it's due to the conflict and due to what's happened to global crude supply. So yeah, I mean, it leads to some interesting political conversations as we move to the back half of the year.
Earlier we talked about market breadth and the rotation. Do we find that as being durable and healthy? Do we think that that's sustained going into the future? Do we think AI makes a comeback?
Yeah.
I got to ask the AI question.
Of course, I know. How long have we been? We've been talking for 40 minutes. No real conversation about AI. It's amazing. What a breath of fresh air, frankly. Yeah, I mean, so kind of cards on the table right up front. I think I've made some of this sort of clear throughout our chat, some of it not so clear. I am a continued believer in U.S. equity exceptionalism, particularly over the long run. And B, given all the different things going on from a macro perspective and from a rate perspective, I prefer large cap stocks to small cap stocks. Mm-hmm. So when we talk about a broadening out, when we talk about a rotation, I have those conversations within the confines, basically, of the S&P 500. Now, that's a big, broad, complicated index, so you can still have a meaty conversation there. But I just want to be very clear that I'm not while I do think globally because I am a global strategist, my focus right now is overwhelmingly on large cap U.S. equities. Now, within large cap U.S. equities, AI, I think, is here forever, right? There's just too much money that's getting spent on this stuff. And for what it's worth, I feel like a lot of the negativity surrounding AI's impact on other aspects of the economy or capital markets is wildly overblown. It takes a very negative, sort of reductive stance on artificial intelligence rather than a positive and productive stance on artificial intelligence. I don't think this thing's going to lead to mass layoffs. I think it's going to lead to market expansion like we've never seen before. That's sort of my take on this. So do the big players, the big investors in AI kind of stage a comeback? Absolutely. I mean, you look at the revenues that these guys are posting, and it blows your mind how much money they are still able to make. Do other companies sort of across the index and frankly across the economy and around the world start to finally benefit from all of this AI hyperscaler investment and find their own productivity gains and increase margins and profitability? Certainly, that's supportive of the broadening out story. You also have kind of the ancillary impact of this AI build out. Like everybody's talking about data centers and warehouses and where you're going to put the chips and how you're going to fuel them. So like now it's not just about the tech companies, it's about the materials companies and the industrials companies and the energy companies. And then you even have like some interesting idiosyncratic stuff, like if the Fed does indeed cut by even 25 basis points at some point this year, but long yields don't move a whole lot, and I don't think they will, the net interest margins improve. And banks, which are already doing great, do even better because that's ultimately how they make money, right? By borrowing essentially for nothing from you, giving you like 2 basis points on your savings account if you're lucky, and then turning around and lending you out a mortgage at 7.5%. Like it's free money. They make an extraordinary amount of cash through improved net interest margins. That's got nothing to do with AI. You have the sort of GLP-1 revolution that's happening in healthcare, what that does to pharma, very little to do with AI. So yeah, I love the broadening out story. I mean, why not? And there's idiosyncratic stuff, there's AI related stuff, there's macro related stuff. The evidence is there. The Magnificent Seven's playing less and less of a role in market performance as years go in and go out. I guess the one caveat to this, Andrew, would be we've sort of been here before. Like we talked a lot about the broadening out of the market at the start of last year, and then Liberation Day hit and that thing narrowed up way right back to sort of where it was in 2024. And the Mag 7 still accounted for almost 50% of the returns last year. Around this time last year, it was closer to 20% of the returns. So this is a market that's liable to bounce around a little bit in terms of a leadership, in terms of what that broadening out actually looks like. And so I guess the takeaway from that would be, yes, things will continue to broaden out, but they will probably broaden out more slowly than you'd like them to, which is what's been happening over the past several years, if you look at individual security performance.
Jack, I know you have to run to another meeting, so we're gonna let you go. Andrew and I probably have another 30 questions for you. Before I let you go, I said to you, before we started the show, and I said to you in the past, I knew your dad. I always appreciate your dad's insight, and I'm sure he'd be extremely proud of you perpetuating his name and the insight you now bring to the same clients.
Thank you.
You've done a great job in maintaining the Jack Manley Senior, and I just wanted to point that out.
Thank you, Michael. For a guy like him with his reputation, that's the best compliment you can pay. I really appreciate it. And as always, it's been a pleasure chatting with you, Andrew. I'm glad we were able to talk too, and I hope we get to do this again at some point in the future.
Absolutely. So we'll see you down the road, Jack. I know you got to run, and Andrew and I will be back right after this break to talk about Jack's comments. All right, I'm Michael Hartzman, back with Andrew Gilmartin, Director at Laberthal Wealth Planning, our financial planning division of Laberthal, sitting in for Dominic tonight. So, Andrew, congratulations on your maiden voyage of the Laberthal report. We've almost made it to the end.
Yeah, thank you, Michael. It's been a pleasure sitting here having a conversation with you and Jack, and hopefully making Dom proud.
I'm sure you are. But he's somewhere in Italy drinking red wine, so I'm sure he'll listen in when he gets back. But I did know Jack's dad, really bright guy, died too young, and Jack is doing a great job in stepping in his footsteps. And the insight we always get from J.P. Morgan, no matter who we get, is always phenomenal. And for me, it was just how calm he was about all of this, how informative he was about all this. Now we kind of put it in context that everyone's hyper focused on the Iran conflict, but there's so many other things that have gone on. He began my head spinning when he talked about all the things that went on just since January. So, what was your takeaway from our conversation?
I share that similar sentiment. There's always a lot going on, and I feel like the headlines tend to pick one thing and run with it for as long as they can. To your point about his calm demeanor, I think that kind of speaks to portfolio management and sticking to a long term plan. He still seems very confident in the U.S. long term. At some point, this conflict in the Middle East is going to end, and I think that'll serve as a good stepping stone for the market to turn its head. And that, maybe the shocking headlines, at least hopefully the shocking headlines, are behind us.
And one thing I didn't get a chance to ask him because we just flat out ran out of time. So I'll put you on the spot and ask you. We had a really good jobs report. It came out on Good Friday. The market was closed. The traders weren't around. The CNBC wasn't on air. So it really didn't get as much attention as I thought it should have. So how surprised were you, that we created as many jobs as we did, in the last month?
I think there's two answers to that question. The first is we all know that month to month the jobs report can be a little volatile. I think the more shocking point about the report that came out last week was how much it beat expectations by. It was almost triple what the expectation was. I think expectation was in 60,000 range. We had a print of 178,000. Um, in some sectors like healthcare and transportation and manufacturing, and maybe the transportation stuff, um, the world needs more people, moving goods and supplies, with the oil conflict. But overall, I think a really positive report. Not to say that we can't get something next month that raises eyebrows, but I think for the time being, we take the good news and run with it.
Yeah, I agree. And one thing I always do in the beginning of the show, and I didn't get a chance because we opened with Jack and kind of switched things up a little bit because he did have to run to another call. But let me just quickly go through the numbers through last Friday, which I guess was April 4th. Um, the S&P 500 through last Friday was only down 3.5%. The Dow Jones was only down 2.8, and the Nasdaq was only down 5.7. And when I say only, I'm not being sarcastic. I'm not using air quotes. Um, I think all of our clients assume, if they don't study it like we do, that it's down more, that their account values are down more. And again, it makes me a little nervous, quite frankly, that it isn't down more. I'm happy it's not down more, but this does seem to be over the last several years, we're able to absorb these shocks to the economy and these headlines a lot more gracefully than we used to.
Mhm. Yeah, and I think part of the story with this one, and to some of Jack's points, is the U.S. specifically around oil is less resilient, um, you know, outside of the country, and that allows us to absorb that shock a little bit. But I agree with you, and you said it on a call internally this morning. You'll ask clients how much do you think you're down, or where do you think your portfolio is at, and they've been surprisingly happy to hear that the numbers aren't as bad as one would expect, whether they're in it every day or not, like us.
Right. And to our credit, we'll pat ourselves on the back, our models have done even better than the market as a whole. So, if the S&P is down 3, a lot of the portfolios I've looked at are down 1 or 1.5. So, and again, that's because we never have all of our money, all of our clients' money in the market. We're big believers in asset allocation.
Mhm.
Um, we're big believers. I'll give you a plug for doing the financial planning. When you rejoined us, your sole intention was to provide financial plans for as many of our clients who were willing to allow them to do for us to do that for them.
Yeah. And I think that the benefit of these plans is it shows people stress test scenarios, right? And so we actually model out for clients what will happen if a market is down 20%. Will that plan still work? And in most cases, we've found that the answer is yes. And I think that gives those clients that we've been able to have those conversations with peace of mind that, okay, if the market goes down, my plan is still going to be on track. I'm going to be able to live the life that I've set out to live post retirement. And I think that has a really calming effect in times where headlines are noisy, even frightening.
Yeah, and Dominic and I talk about headline risk, constantly. And when headline risk leaks into real world risks is when we typically start to rebalancing the portfolios. And we started rebalancing about 7 or 8 weeks ago. And we're not always right. And sometimes the criticism is we're holding on to too much cash. But when we get into scenarios like this, clients suddenly are super grateful that we are holding on to the cash that we are, having off to the sidelines, A, for safety, and B, to buy on these dips.
Yeah. I think in any time we're able to work with a sense of urgency, we can, move money or allocate money with basically the snap of a finger. And I think that leading up to this conflict, the investment team, you and Dom, saw that negotiations maybe weren't going as hoped. And we're happier being conservative with our clients' money rather than a wait and see approach. And this year, pat on the back, it's helped our clients, it's helped the portfolios, and I think we've all heard positive feedback because of that.
Absolutely. So listen, Andrew, congratulations on getting through your first podcast. But don't exhale yet, because next week I'll be out and Don will be sitting in and you'll be sitting in for me. So thank you for making the extra time for us this evening. And Andrew and Dominic will be back next week with a new edition of the Labor Thought Report. And I'll be taking the week off on vacation.
Well deserved vacation.
Thank you. Have a good night, everybody.